now I'm going to invite David to come back up to the stage. David's going to be talking about basically whether when it's right for a company to have an employee stock ownership plan, what a company should know. This should be a great session that focuses on a lot of the key issues. I should also give some context. Bloomberg B&A, which is the largest of our industry verticals, was an ESOP company. Bloomberg acquired it about 2.5 years ago for $1 billion. A lot of what Michael just said in his presentation is true. It was an ESOP that fit the company well. A lot of employees cashed out, created a bunch of wealth, but also very little attrition. A lot of employees stayed on after the fact, and that's really served us well. So with that said, David?
Thanks again, Scott. Michael gave us a great picture of the forest, as he always does. And one thing I'll say about Michael, too, you should attend the ESOP Association's annual conference at some point in your life. And if you do that, you'll get an opportunity to go up to Gettysburg. That's Michael does this great presentation about how employee ownership in Gettysburg are related to one another, and I can't do it nearly the way he would do, so you have to go do that. Commit to doing that and attend the conference, and you will enjoy that presentation. And that's where he tells the stories. And I've heard a lot of Michael's stories, and they're really good, and enjoy that if you can. One thing I also want to say quickly, too, we've got Becky Miller here, who's one of the most renowned CPAs, experts on ESOP accounting in the country, and she asked me to make sure that I didn't cover everything on employee ownership, the trees, during my presentation, so I'll try not to do that, Becky. And also, I just want to say, too, Rob, thanks, Rob McCourt, a truly key CEO of a great employee-owned company, one that, you know, we talk about all the great things about ESOPs, and I'm an ESOP advocate, too, Michael. There are ups and downs with ESOP companies, and I think the one thing I respect about Rob and his company, Roundtable Pizza Corporation, is that they actually went through some downs and some tough times, and they've come out the other side, and what that meant is fabulous equity ownership for a lot of great people. So you'll hear from Rob later as well. And Scott, thanks again for the opportunity today. What I'd like to do is, again, pick up where Michael left off. I'm not going to talk about the alternative exit strategies. I will talk a little bit about criteria for evaluating your alternatives. Introduction to ESOPs is the main thing I'm going to talk about, a little bit about how an ESOP works, corporate governance in an ESOP, and I'm not going to sit here and tell you only the good things about ESOPs, because I've been doing this since the mid-1980s, and ESOPs sometimes can be challenging too. So when we come to a subject matter that I think is challenging, I'll describe that to you. And there's something called ERISA, and there's something called ERISA fiduciary responsibilities. And you can't take this stuff with a faint heart. You have to be, there's a famous phrase in a famous case involving ESOPs, Donovan v. Cunningham, and the famous line in there is, pure head, empty heart, that doesn't satisfy the ERISA fiduciary responsibilities. So I think you have to take it very seriously. Michael talks about all the great things about ESOPs. I think they're fabulous. But go into it with your eyes open, understand what the responsibilities are, work with professionals who know what they're doing, and take your responsibilities very seriously throughout the entire process. And then hopefully you come out with some great equity opportunities for your employees. And I would attest to what Michael says, too, that I've probably worked with well over 500 companies in the last 30 years, and I've seen that in most of the cases, in over 90% of the cases, the compensation, the value of retirement benefits, the value of benefits in general, generally tend to be greater in ESOP companies than non-ESOP companies. That's not a formal Rutgers study, but that's Dave Johansson's view of the landscape over the last 30 years. So what I'm going to start with, Michael started with this. Michael gave like 6 or 7 opportunities, but you could sell to a strategic buyer, you could sell to a financial buyer, or you could sell to an ESOP. We're going to focus on selling to an ESOP, the ins and outs of selling to an ESOP today during the next roughly 40 minutes. Criteria. Purchase price. One thing I'll say to you is that an ESOP is not necessarily the highest, best value for a selling shareholder. I mean, if you're a selling shareholder, you're not necessarily going to get the greatest price. If you do a strategic deal in which you're selling your company to someone who needs to buy your company for a strategic business purpose, that's probably going to be your highest value. The ESOP may not be your highest value. You will, however, get the opportunity to potentially defer taxes on your sale of stock to an ESOP. There are some requirements in order to do so. And then I think you should think about, when you're looking at the alternatives, wealth diversification. And also, I think one of the best criteria for ESOPs is the legacy factor. Many companies that I work with that end up going in the ESOP direction, they don't want to do what Michael was talking about and sell to a third party, have the strategic buyer or the private equity group come in and slash benefits, slash the accounting department, the finance department, the human resources department, use a headquarters in New York. I'll pick on my buddy from New York, the big strategic equity players. That's not for many founding owners. They want to leave a legacy, and the ESOP gives them a great opportunity to do so. I also think that you can, if you go about ESOPs properly, you can align the interests of management quite carefully, quite closely rather, with those of the employees. And so if you've got a benefit plan where the value of the ship rises, and Scott talked about B&A. I mean, selling for $1 billion to Bloomberg, I mean, that's a fabulous opportunity for the employees. And there's actually one ESOP participant sitting in the back who was a participant who's waving her hand back there. And that's great. She got liquid. She got to defer that, take that equity out and defer it and use it for retirement purposes down the road. And I guess I'd say the other thing is time to close. Everybody always, the first question owners always ask me, and I typically work with corporations and founding shareholders. And our group, we've got a bunch of members of my group here today, and we've got a national team who works on ESOPs. Typically, owners' first question they ask, well, how long is it going to take? Okay, and it could easily take sometimes as much as 4 to 6 months and maybe even a year sometimes if you're really trying to plan it properly. And I've even got one deal that's not getting done in December that probably should have gotten done this year, but it's not because the process of due diligence that the ESOP advisory team is going through has just got to take its course. It's got to be done properly, and they're taking their time to do it, and we're going to let them do it. So it really is something that can take a lot more time than you'd probably anticipate. And there's a lot of frustration with that too, quite frankly, for founding shareholders. So I'm going to skip through, as Becky says here, I'm not going to try to hit every slide in the 57. I'm going to leave some stuff for Becky to cover, and I know she'll do a great job of that. Michael talked a little bit about this. An ESOP is an employee benefit plan. He talked about the Kelso days, and actually, we used to talk about Kelso creating ESOPs, but now Michael has told us the truth that it was done way back when in the 1920s, so we learned something new today. San Francisco is one of the pioneering cities, though, in employee ownership throughout this country, and Kelso went around through the bars and clubs and everything throughout San Francisco and proselytized about employee ownership, and he got a lot of people interested along the way. And a lot of the consultants and attorneys that worked with Kelso became some of the founding people in the employee ownership movement throughout this country during the last 30 years. So primarily invested in company stock, meaning something typically more than 50%. You can't have an ESOP that's got something less than 50%, or you won't meet the requirements, at least for an ESOP, if you do that. And then I think one of the key criteria, and Becky may talk a little bit about this too, is the selling shareholder tax deferral. A selling shareholder, in California now, we're fortunate enough to have this great tax rate here. So we've got a capital gains tax rate of now 23.8% with the ACA tax. And then if you're at the highest tax bracket, you've got upwards of 12, 13% on the state level. So you're looking again at a capital gains tax of over 35%. You can, if you properly structure an ESOP transaction, you can sell stock to an ESOP trust, take the proceeds, and reinvest it in stocks or bonds or U.S. companies and defer your taxes. So let's just take on every $1 million of a transaction, you can potentially defer the capital gains on that sale to the tune of $350,000 or more if you're a California resident. That really drives quite, excuse me, quite frankly, a lot of transactions. And it continues to, and the law on that, Michael, has not changed since 1984, I think. So that's been, I like Michael's comments about that. That's another question that business owners ask me about all the time, and companies. Well, are they going to take away these benefits? You know, Rob's a 100% owned S corporation ESOP company. There's no tax at the shareholder level. There's no tax at the corporate level. So Rob gets to operate this for-profit company, Rob at Round Table Pizza, that doesn't have to pay any taxes, or it's got a 1.5% tax rate in California. Of course, we got to have the different rule in California again. But that said, Rob gets to accomplish for the benefit of his company and his employees some great tax savings that allow it to generate opportunities for the corporation to invest those tax savings and create more wealth for the employees, rather than paying it over to Uncle Sam or the state of California. So that's tax incentives tend to drive ESOP transactions. I do want to say to you, though, too, don't get too tied up in the tax incentives, because I know we've got a gentleman here in the outreach group at the National Center for Employee Ownership, Timothy, and Tim and his group, the National Center for Employee Ownership, was founded by Corey Rosen. He used to be an advisor to Russell Long with all of the tax legislation that was passed way back in the 80s. And the National Center for Employee Ownership focuses on one key thing, at least I've seen them do that, and I appreciate that about their mission, which is to combine employee ownership and the tax incentives that go with employee ownership with creating an employee ownership culture. And I know, Rob, you've done that at Round Table Pizza, and I think it's really important to try to educate excuse me, employees about employee ownership and why it means something to them and why it's beneficial to them. If you do that, I think you're going to get more out of your ESOP. If you don't do it, I think it's just going to be a financial and tax device, and you're not going to get as much out of it. Excuse me. The ESOPs, as Michael said, can be leveraged. There's contributions under Section 404A3 of the Internal Revenue Code, and those contributions are basically 25% of comp. So if you take, let's say I have a $10 million payroll, you know you can create a non-leveraged ESOP, put $2.5 million worth of dollars into your ESOP trust and deduct that on your corporate tax return. It's a great benefit for employers as well. That's one of the reasons why I got involved in ESOPs way back when, was I like the fact that you combined these tax incentives for the company, excuse me, tax incentives for selling shareholders, tax incentives for employees, the ability of employees to grow the value of a company tax-free within their retirement accounts, and everybody's boat rises together. If you combine those together, it's a great idea. So it's a conservative idea, it's a liberal idea, it's a positive idea for all, quite frankly, and that's the benefit of ESOPs. The other thing, excuse me, that can be done with ESOPs is a leveraging. So you can, under Section 404A9 of the Internal Revenue Code, and as Michael pointed out, what the Kelso group brought to the table and what the ESOPs in 1974 brought to the table was the ability to leverage. So now it's a qualified retirement plan that can actually borrow money. It can borrow money from a financial lender directly, or it can borrow money from the corporation and then use those proceeds to buy stock from selling shareholders. And that's a great opportunity as well for ESOPs to create tax deductions for the corporation and equity for the employees. As we said, one of the key benefits of ESOPs is employees typically don't have to put anything into it. In fact, most ESOPs, you've heard about the Enron ESOP, that's one of the bad stories. Enron had an ESOP, and obviously we know what happened, many of us know what happened with Enron. The value of the stock dramatically tanked, and these went bankrupt, and the employees lost a bunch of money. Most ESOPs, over 90% of ESOPs, are typically accomplished without any deduction from your payroll. So the employees still get the same wages, and they get large retirement plan contributions that are allocated to their accounts for purposes of acquiring this equity. And so from an employee's perspective, I've heard employees come to a meeting and say, well, hey, I maybe don't want to participate in this ESOP. Well, that's kind of a silly question because you're going to get your same pay and you're going to get allocations, tax-deferred allocations in your retirement account. Understand the value of the benefit may or may not increase. And that's one of the things that I think we need more education out there about. The regulatory agencies typically focus on the fact that you have to keep the value the same. Well, that's not the law. ERISA doesn't say that you create an ESOP and you buy stock from the company and it's always got to stay at the same level or get higher. There's a chance that it may decline. And obviously Enron's one of those situations where it declined dramatically. And Rob can talk to you a little bit about the challenges of those declines in values. But value, hopefully, with the efforts of all, goes up over time and it benefits, it rises the ship for all of the employees as well as the company. And that's what we try to create with employee ownership, is that kind of environment that creates a team effort to collectively improve the profitability of the company. And when you improve the profitability of a company, typically the value raises. By the way, I'd be more than happy to answer a question once in a while too, so please interrupt me if you have any questions about ESOPs or the subjects that Michael and I are talking about here. At retirement, typically what happens is you get cashed out over a period of time, and then the employee can roll that benefit over into an IRA and then take the money out of the IRA, the liquid asset that is now cash and invested in other investments, can take that and use it as they need it during the retirement years when they don't have the same earnings that they had prior to their retirement. I'm going to jump down a little bit. We've already talked about advantages of selling to an ESOP. We had talked about the employer deductions under Section 404A3 and 404A9. Again, substantial tax deductions for employers. One of the ones I haven't talked about yet is a deductible dividend. There are some companies, and there's what's Medtronic, right, in Minnesota. Becky and I are both from the great state of Minnesota, and she gets fortunate enough to live on a lovely farm out there, and I'm envious of Becky. But Medtronic was a company that was a high-value company that didn't have necessarily that large number of employees. And a friend of mine, Bruce Grussing, used to be the counsel, the corporate counsel to that company. And what they did over time was, instead of just simply making the 25% of contributions to the ESOP over a period of years, they also declared deductible dividends on top of that on the stock that was held by the ESOP. They're the only types of deductible dividends under the Internal Revenue Code, and those were used to finance the acquisition of the stock because the payroll of the employees was relatively low relative to the large value of Medtronic, which was a high-value heart valve company, for lack of a better word. So, I mean, that's probably not a perfect description, but it's generally true. And so what you can do when you've got a high-value company with a relatively low level of employees and you can't put enough money into the ESOP to amortize the debt that's incurred to buy the stock in the first place, you can declare deductible dividends on the stock that's held by the ESOP, and then the ESOP can use those to repay the debt. That results in allocations to participants' accounts that could be dramatically more than 25% of comp. In fact, there's another company in Minnesota, the Anderson Windows Company. I remember stories 25, 30 years ago where the employees who were working at this manufacturing company, Anderson Windows, would get 70, 80% of their salary each year in the form of equity in addition to getting the regular compensation. So that was a great employee ownership vehicle for those folks, and retirement vehicle. One other thing I haven't really talked about a lot yet is S Corporation ESOPs. I'll pick on my friend Rob again at Roundtable. When you've got a company that's owned 100% by an ESOP trust is tax exempt. So therefore, and if you're an S corporation, you know that there's no shareholder level tax and no corporate level tax. Now you've got a situation where you create an environment of no taxes, which allows you to dramatically increase the value of the company over time. And in fact, Michael talked about that. That dates back to 1998. In fact, for a while, there was all this anti-abuse legislation because people were setting up one-person ESOPs to create a great benefit. All of those went away, but the law stayed, and Bush signed it into law finally in June of 2001, and it's been with us ever since without any changes, with the anti-abuse provisions in place so that people don't take advantage of the bad part of that. But that's, again, a great vehicle for employee ownership, great tax incentives. I'm going to jump down a little bit past the profile. And by the way, anybody who wants a copy of the presentation, Justin's here. You can certainly ask him for a copy of it, and we'll get it out to you afterwards. I don't think we have any hard copies of it today. So now let's talk about corporate governance. And I don't just want to, I could sit here like Michael and Becky and Rob talk about all the great things about employee ownership, and I think you need to look at all sides of it. And it's not for everybody. And as I've said for years, an ESOP is not a panacea for all issues that are ill in the world, and it's maybe not right for everybody. I know Michael's an advocate, I am too, but it's got to fit the circumstances. So one of the things that you need to deal with an ESOP, which I think you need to deal with right at the outset, and when I started in the employee ownership world, I used to think it's great to have employees be trustees of an ESOP. Trustee means you have an ERISA fiduciary responsibility. And after 30 years of doing this and seeing the personal liability that comes with the role of being a trustee of an ESOP, and seeing the growth in the institutional trustees that are out there and being involved in creating ESOPs and being trustees for ESOPs, my perspective right now is that instead of having the employees be in that top box as ESOP trustees, I strongly recommend that clients just avoid ERISA fiduciary responsibilities altogether and simply have outside directors of the corporation appoint an institutional trustee. So now it's not the Rob McCourts, the presidents and CEOs and the general counsels and the CFOs. Have a couple of outside directors serve on an ERISA fiduciary committee and have those folks select and monitor the institutional trustee who's going to run your ESOP. And you can hire an individual. You can hire, there are many institutional, there are a number of well-qualified individuals in this country who can fill that role, and they have plenty of fiduciary responsibility insurance. And you can hire institutions. There's lots of great institutions throughout the country who do that. So that's my first lesson to the wise here is don't serve as an individual trustee in an ESOP transaction. I just don't think you need to do that. And I think there are so many potential conflicts associated with that and your role as an officer. I mean, picking on Rob again, if you're an officer, a director, you're an ESOP participant, you're an ESOP trustee, it's just wearing too many hats. Even though the law allows you to do it, I don't recommend that you take on that fiduciary responsibility. So what happens is the board elects that or appoints the trustee. And then what's funny with, and again, with Rob's company, the Roundtable, which got 100% owned ESOP, what happens is the board of directors selects the trustee, but guess what else happens? Then the trustee acts on behalf of the ESOP trust, which owns the stock, and elects the board of directors. So there's another place where you probably want to create a nominating committee on the board of directors that consists of non-ESOP participants, non-officers of the company, and they can create the slate of directors every year, present that to your institutional trustee, and then you virtually have no conflicts in the corporate governance process. You also see on here we have a slide that talks about ESOP Advisory Committee. That's, and again, picking on Timothy back there, they have great educational materials, both at the ESOP Association and the National Center for Employee Ownership, about how to create an active ESOP Advisory Committee. It's not a fiduciary committee. It's just designed to teach employees in general about how your ESOP works and how it relates to them. You see all the technical stuff we're talking about, and Michael did a great job of the forest. I'm getting into a lot of the trees, but those trees do need to be explained to the employees in a way that makes sense to them. So I do encourage you to establish an ESOP Advisory Committee. Have that committee consist of all walks of life at the company, maybe line employees in a manufacturing company, pizza delivery people in your pizza company, pizza makers, so on and so forth, and have them design a program that works for your company. As Michael said, how does a well-run ESOP company works? Work within your industry, do what works within your industry, and I'm sure we'll hear more of that from Rob later on. Kind of jumping down the road here, the other thing I guess I'll say is that the ESOP trustee has a responsibility to establish in good faith the fair market value of the company. That's where most disputes involving ESOPs appear, and our firm has a national practice. We both do the implementation of ESOPs, but we also defend fiduciaries who happen to get sued in transactions involving ESOPs. So the place where all the action is, as far as I'm concerned, is in valuation. And that requires you to essentially have a trustee, typically the institutional trustee, who will go out and select an independent appraiser and financial advisor. And that independent appraiser and financial advisor will collect due diligence from the company. And typically in that process, we don't like to see that, we like to see the process work in a very formal way. So set up a data room. Now you got these great electronic data rooms. You can put all the data about the company in there. Have the ESOP advisory committee consisting of the trustee and the independent appraiser collect all that data. Have the attorney for the ESOP. There's usually got to be a separate counsel for the legal counsel for the ESOP. Have them work together and have the trustee actually establish the fair market value of the stock based upon an independent appraisal of the company. And that whole process of creating the data room, providing information to the ESOP advisory team, evaluating that information, having the ESOP advisory team interview the officers and directors of the company about the company's performance, that is where all the action is in terms of, in my opinion, potential ERISA fiduciary responsibility, because if the value is not established properly and the ESOP buys stock for more than fair market value, guess what happens? The trustee could potentially get sued for having personally, or if it's an individual or a company, the institutional trustee could get sued for buying stock for more than fair market value. And that's the part of ESOPs that I think people need to spend more time on at the upfront stage to make sure they don't have issues on a day-to-day basis. Jumping down, I've already talked, I'm going to skip over so that I meet Becky's. I don't go over every slide here. So now we're getting down there, Becky, to the end here. How does an ESOP work generally? Two forms I just want to go over quickly. A non-leveraged ESOP. Non-leveraged ESOP is a great vehicle to start an ESOP company with. Let's say that we're not ready to do a transaction yet, but we're just getting ready. What we can do is we can go through all the fiduciary requirements we talked about, set up the board of trustees or the institutional trustee, have them hire their independent appraiser, have them hire counsel, and then the corporation can start to put money from the corporation into this ESOP trust. And over a period of years, maybe they put 25% of comp for 2 or 3 years and create a fund that is available, a cash fund that's available to buy stock without leveraging. Leveraging is great, but leveraging can be bad, because if you leverage and you don't have enough profits to pay off the leverage, then you may have financial issues for the company. So this is a way to create, kind of walk before you run with an ESOP company and slowly get into it. The other thing you can do with a non-leveraged ESOP is just take authorized but unissued shares. And there's a great story about a company in Southern California that became a and Corey Rosen tells the story much better than I ever will at the National Center for Employee Ownership, but a guy who owned 100% of a company that started giving away stock to the ESOP trust over a period of years, and then it became a multi-billion-dollar company. And that company ultimately was named SAIC, and it was a huge ESOP company at the end of the day that created great value for a lot of people. And it started simply by taking authorized but unissued shares of stock, valuing them, putting them into the trust, allocating it to participants, and created a great ownership vehicle which was non-leveraged and became a great opportunity for people to share in the equity of the company. The other thing I'll point out here is, at the end of the day, we've talked about this already, at the end of the day, and most of the ESOP companies we work with are closely held, so they don't have publicly traded securities. If they're closely held, the company needs to make a market for that stock at the end of the day. So the only way the employees get value is to have the ESOP account distribute the stock to the employees. The employees then put or sell that stock back to the company. Company makes a market for that stock at the current fair market value, and then the employees have the opportunity to either roll it over to an IRA tax-free and keep it in that IRA for purposes of retirement down the road, or they can spend it to live on at that time. And that's the general structure of ESOPs, and that's called repurchase obligations. It's really important to get your handle on repurchase obligations up front rather than when you've had your ESOP in place for about 5 years. It really is something that I strongly recommend my clients get a handle on really up close and personal at the start. Leveraged ESOP, the only difference we have here is that now you may actually go out to a bank. The corporation may borrow money from a bank. The bank may loan the money. Typically, you got to deal with all the issues of collateral and loan term and interest rate and other things like that, other fun things like that. But then the corporation will reloan those dollars to the ESOP. The ESOP trust uses the dollars to buy out selling shareholders, and then you create a batch of stock in a suspense account. And as the corporation generates profits down the road, the corporation takes the profits, puts it into the ESOP trust. ESOP trust pays it back to the corporation, and then we allocate the stock over a period of years. And sometimes those loans are 10, 15, 20 years where we'll allocate, because that'll allow us to allocate to the greatest number of employee owners over a long period of time. That's the only difference with a leveraged ESOP, and there are differences in deduction levels, and there are differences in ultimately how you get the money into the trust, but it essentially is the major difference between a leveraged and a non-leveraged ESOP. I'm going to save this one since I'm going to save this one for you, Becky. You can cover tax-deferred reinvestments. This is a selling shareholder tax deferral that in California could save you upwards of 35% on each dollar. You could defer that, and potentially the deferral becomes a complete tax avoidance if done properly. And I'm sure Becky will tell you a little bit more about that. And it's just a slide showing my $370,000 worth of savings in California, which is, to me, it's a fabulous tax benefit. And if an ESOP is right for me as a founding shareholder, and it makes sense, and I've got the financial profitability to make it work, it's, why not consider taking advantage of a tax deferral and selling your stock to an ESOP? This stuff is the stuff, I've got my partner here, Rachel Markin, and she loves to talk about this stuff because she's, I won't even say what she is, but she's one of those ERISA persons who really loves to talk about the technical nits and gnats of ERISA and how you, and actually, Becky and Rachel are in the same club, I think. They're in that same ERISA club. I'm kind of a side member to that group. But plan design considerations are very important, all kidding aside, and we could spend another 20 minutes talking about that. But I won't bore you with those details or with those trees, as Michael says. They're very important. They're very important from a compliance perspective. There's both Internal Revenue Code compliance and IRS issues, and there's U.S. Department of Labor issues related to these plan design features, investing, and so on and so forth. And maybe, Becky, you might talk a little bit about, nope, she's not going to. Okay. We talked about ESOP repurchase obligations. I think I'll talk a little bit. I think this is a worthwhile topic because this goes to and I sometimes use the phrase dark underbelly of ESOPs, and that's probably a little bit too harsh, but it can be true, quite frankly, because we do. I used to say I was just an ESOP lawyer, but now I feel like we're both ESOP lawyers and transactional lawyers, and 100% ESOP lawyers and transactional lawyers, but we spend a lot of time on the regulatory side, complying with IRS audits, complying with U.S. Department of Labor investigations, defending good people who do ESOP transactions as individuals and get accused of doing bad things that necessarily aren't true. So here's where I think it's really important for you to understand the standards. And the standards are really important. Going back to my other point, that's why my typical advice to clients now is don't get involved in these standards yourselves. Just go out and make sure that you get outside directors who appoint a well-qualified institutional trustee, and then have those outside directors monitor the well-qualified institutional trustee, and that's a great opportunity to completely avoid ERISA fiduciary responsibilities. So you got two things going on. And B&A is very familiar with this because you do a lot of reporting about corporate law and corporate transactions and corporate litigation, and when someone makes a business judgment decision and when someone doesn't. And we learned, you guys, both of you learned that at your law schools, right? Even though you went to two different schools. Amherst? Okay. So you did learn that at that same law school. And the whole issue is business judgment rules. So as a corporate issue, most corporations have state laws that deal with the same law, and that's the business judgment rule. So now as a business judgment matter, you on a board of directors or an officer, you can live by a standard that's basically applying a gross negligence standard of review. It's not the top standard of compliance known to mankind, the top fiduciary standard. So if you make what they say is if you make a reasonable business judgment and you haven't engaged in gross negligence, you're going to probably meet that standard for corporate compliance with your fiduciary responsibility, your corporate fiduciary responsibility to the corporation and to its shareholders, okay? That's fine. But when you get into ERISA, what happens is you're held to the highest standard of prudence known to mankind. And it comes from the law of trusts. And all of us who unfortunately had to go to law school to become lawyers learned that there's a restatement of trust that you had to learn about, and that had all these rules about trust laws. And those same rules about trust laws basically have been taken over and adopted to make up ERISA, what we know as ERISA, the Employee Retirement Income Security Act. And under ERISA, you have to meet basically what's called a prudent expert standard. So again, hence the advice to just not get involved in this and let professionals do it, because guess what? There is personal liability. So if you have a home and you have created assets and you've created accounts outside of your business life, all of those can potentially be subjected to ERISA fiduciary responsibility if you choose to individually serve as a trustee. And so a lot of people who run ESOP companies for that reason run away from these issues that we're talking about. And it's clearly a different standard here that takes a lot of effort to comply with. And in some cases, you just can't. You can't. The conflicts are too much if you're the officer and director of the company, you're the chairman of the board, you're the CEO, you're the CFO, and you also are an ESOP participant, and you've got executive compensation. You might have executive compensation benefits. It's hard to comply with all those rules, and it's easier to hire an institution. Jumping down, who could in theory be an ERISA fiduciary? Well, a board of directors. The way the board of directors becomes an ERISA fiduciary is if that board of directors selects an institutional trustee. That's why we advise our clients to set up a committee called an ERISA fiduciary committee of non-employee directors who are not connected with the company in any way, don't make their living off the company other than serving on the board of directors for a nominal fee each year. And those folks are the ones who would then have that fiduciary responsibility. The ESOP Advisory Committee that I talked about, the committee that educates people about ESOPs, typically doesn't have ERISA fiduciary responsibilities. The plan administrator may or may not. Again, that's something I'll leave up to Rachel and Becky to talk about if they have anything they want to say about that. But plan administrators can be an ERISA fiduciary, depending upon what the plan document says about what their responsibilities are. But then there are things called settlor functions that by law are not ERISA fiduciary functions, and that's defined in the plan document. Company executives typically are not ERISA fiduciaries. And then outside advisors, the law generally is that they're not, but if they become involved in making ERISA fiduciary decisions. If they control the assets of the plan or the administration of the plan, potentially they could be ERISA fiduciaries. One thing I guess I'd say about ERISA fiduciary issues too, and it may be later in the presentation, I'm almost done with my 45 minutes, but the key is look for those situations. If you are an individual who's an ERISA fiduciary, look for those situations where you might have a conflict. You might have executive compensation benefits as well as equity outside of the ESOP, and then have equity within the ESOP, and you may be making decisions about various things that conflict with one another and conflict with how the value of the ESOP goes relative to your value outside of the ESOP and relative to your executive compensation and equity incentive benefits. The other thing I'd say about ERISA fiduciary responsibility, hire or acquire a really good ERISA fiduciary insurance policy. There are great carriers out there, and I'm not doing any commercials, but there are good carriers and there are carriers who aren't so good. People who make decisions when the chips are down that aren't so beneficial to providing coverage, and then others who are generally going to make coverage. But look at the value of benefits you have in the ESOP. If you've got a $40 million ESOP company, you probably don't want to have $1 million worth of ERISA fiduciary insurance. You might want to think about something a little bit more than that. And if you've got a small ESOP company, if you're 1, 2, 3 million, you know, maybe $1 million worth of insurance is enough. But look at the terms of the policy, get it bound. Typically, you can't bind it until they're saying now until you actually have stock or assets in the ESOP. It's funny how that industry has changed. But make sure you go through that whole process before you form your ESOP so you've got that coverage down the road. I talked a little bit about this already, the general regulatory framework. We've got 2 agencies who typically are responsible for monitoring ESOPs. Tax matters are the U.S. Department of Treasury. They operate obviously through our lovely Internal Revenue Service organization. And Becky and Rachel and I have done a lot of fun audits with them over the years for our corporate clients. And there's a lot of compliance issues, technical notices, IRS notices, revenue rulings. You can get, there may be some times when you need to get private letter rulings about particular technical issues. And what I've found is that the IRS and the Department of Treasury tends to have adopted actually a better approach, I think, toward ESOPs than the U.S. Department of Labor, which is, you know, no harm, no foul. If you report your problems to us in advance, there are programs that are available to correct potential problems, and they'll give you a clean bill of health. The Department of Labor has not been as generous with that approach. You know, we've probably defended 300 or 400 ESOP investigations from the Department of Labor over the last 30 years. And some of them tend to be quite easy to deal with, but others, you wonder, you know, they back the truck up to your place of business and say, okay, we'll fill up 7,500 boxes and we'll take a look at them, and then you spend 2 or 3 years dealing with that. So it can be quite cumbersome and expensive, and can add to your budget. Like Michael said earlier, the cost of administering an ESOP can be quite difficult in that respect. There is a general framework for getting an ESOP qualified under the Internal Revenue Code. Again, something that Rachel would love to talk about, and I know Becky may talk a little bit about that. And I think that, reporting to Form 5500s that Becky may talk about, you actually have an information return that you need to file each year to report to the regulatory agencies what you're doing. It's not a tax return, but it's telling them how many employees you have, what the value of the assets are, what kind of assets you have in the trust. And then if you're 100 or more, or 100, is it 125? I can't remember. It's either 100 or 125. You've got to have an audit. So you get a firm like Becky's to come in and audit your Form 5500. So I've enjoyed, I see I'm down to about 1.5 minutes, so I always wanted to start early, or start on time and finish early. That's about all I really want to talk about today, and I look forward to the opportunity to meet a few of you later on. Thanks for the time to talk about one of my favorite subjects, ESOPs, and they're not for everybody. There's pros, there's cons. There's a lot of positives. If you do them right and you invest the time to hire the right advisors to implement an ESOP and manage your ESOP down the road, you can create a lot of benefits, and you can benefit employees, corporations, selling shareholders all at the same time. So thanks again for your attention, and I appreciate the opportunity to be here today.